A year ago, French streets were thick with Teslas. Today, they're vanishing. In 2025, Tesla's sales here collapsed nearly 80%, from over 13,000 cars last year to fewer than 3,000. It's one of the steepest declines the company has seen anywhere. And it's not just France. Across Europe, while EV sales are booming, Tesla's share is shrinking fast. But the real story isn't just about Tesla losing ground. It's about the rivals taking its place. Companies playing a different game entirely. One built on aggressive financing, hidden debt, and sales tactics that push the limits. And if that game cracks, the shockwaves could hit every corner of the EV world. Picture this, a sunrise over Shanghai's massive autoport. Rows upon rows of gleaming EVs stretched to the horizon, each one lined up like soldiers waiting for deployment. Cargo ships, each the size of a city block, are being loaded for Europe, Southeast Asia, and Latin America. This isn't an occasional shipment, it's a daily ritual. China now exports more cars than Japan, Germany, or the US. Over a quarter of them are electric. It looks like unstoppable dominance, until you dig under the surface. Take BYD, the world's largest EV maker. On paper, BYD reports about $3.8 billion in net debt, but independent analysts who've examined its supply chain financing, including commercial bills issued via BYD's D-Chain platform, estimate that total effective obligations could be in the tens of billions, with some putting the figure near $44 billion, once supplier IOUs are included. Here's the play. Instead of paying in 45 to 60 days, the global norm, suppliers may receive promissory notes that can be passed along or pledged at banks. Some suppliers have reportedly waited as long as 275 days to be paid, according to investigative reports. On paper, the balance sheet looks clean. In reality, the debt is pushed down the chain. Strategically, this frees up cash for R&D, price cuts, overseas expansion. But it's a double-edged sword. If sales slow, rates rise, or suppliers push back, that cash advantage can flip into a time bomb. Under pressure. And with new rules taking effect, June 1st, 2025, major Chinese automakers, including BYD, Geely, NIO, have pledged 60-day supplier terms. If they truly shift, we'll see how much of their speed depended on that hidden cash cushion. And BYD isn't the only one with a creative playbook. The deeper you look, the stranger the sales numbers get. When customer cash slows to a drip, some automakers have a way of keeping their war chest full. And the method is as creative as it is controversial. Inside China, multiple investigations, from Reuters, Caixin, and Chinese state media, have found cases where automakers, including BYD, register brand new cars as used with 0 mileage. On paper, it's a sale. The vehicle counts toward delivery targets, incentives can be claimed, and quarterly numbers look stronger. In reality, the car may sit in a lot for months before anyone drives it. Here's how the loop works. Dealers or affiliated traders pre-register the cars, sometimes even starting insurance policies, but don't move them to real retail buyers. These units are later resold, often at a discount, to clear space. And while they're sitting, the automaker hasn't yet been paid in full by end customers. But thanks to stretched supplier terms, they don't need to pay for the parts right away either. The phantom sale plus delayed payments together create an artificially smooth cash cycle. The scale is bigger than a handful of bad actors. Industry sources have linked thousands of vendors, often quoted in the 3,000-4,000 range, to this channel. And it's not confined to domestic lots. Local governments have helped push these 0-mile used cars into export markets like Russia, Central Asia, and the Middle East, a grey export route that removes stock from domestic tallies while inflating foreign sales. One 2024 trade analysis estimated that up to 90% of China's exported used cars that year were actually brand new. Regulators have taken notice. The Commerce Ministry has summoned automakers and industry bodies, with proposals ranging from limiting resale windows after registration to closer cross-checking of registration and insurance data. The language has shifted from ban to regulate, hinting at lobbying behind the scenes. Meanwhile, some automakers have defended these registrations as demo or showroom cars, but public backlash is mounting. The bigger question: how much of the EV boom is genuine demand, and how much is an accounting illusion propped up by creative registration and elongated payment cycles? If policymakers close both loopholes, the combination could squeeze cash flow overnight, exposing just how much of that breakneck speed was running on borrowed time. And yet, even with these cracks, China's EV champions are still pulling ahead. So if part of the boom is smoke, what's the fire? It's in the cars themselves, the way they're built, priced, and launched at breakneck speed. The next move in this story could change the EV game. Subscribe to StratyQ so you don't miss it. If the registration games and stretched supplier terms are the smoke, the fire is the roar of engines and the rush of shiploads of EVs leaving Chinese ports. A market offensive unfolding in real time. China's automakers aren't just competing, they're flooding markets with a scale, speed, and price aggression the industry hasn't seen in decades. From battery giants to tech-born newcomers, each is playing a different card, but the playbook is the same. Scale fast, cut prices, and expand abroad before the dust settles. BYD, vertically integrated from raw lithium and nickel to finished battery cells, uses that control to slash costs. In Europe, its Dolphin Surf starts around €22,990, roughly $26,000, undercutting Tesla's Model 3 by thousands. Tesla. The Model Y remains a sales machine, still among China's top-selling vehicles, with roughly 480,000 units moved in 2024, despite intensifying local competition. NIO, betting on infrastructure with 3-minute battery swaps and a growing European network to erase range anxiety. XPeng, refining driver assist tech that rivals, and in some daily scenarios, outperforms autopilot. Xiaomi, the YU7 SUV announcement lit up order books. Approximately 200,000 reservations in the first 3 minutes, approximately 289,000 within an hour, per company filings and media reports. Not all will convert to deliveries, but the initial demand shows brand power is crossing from smartphones to steering wheels. Exports are surging too. In 2024, China shipped approximately 1.28 million new energy vehicles. That is EVs, plug-in hybrids, and fuel cell electric vehicles abroad, several times more than just a few years ago. But beneath that momentum lies a brutal price war. It kicked off when Tesla began a series of aggressive price cuts in China, forcing rivals to match or risk losing share. The spark hit an already overbuilt market. Dozens of brands chasing limited demand growth, all backed by heavy state incentives. The result? Sticker prices for some models now hover around $15,000. For consumers, it's a windfall. For automakers, it's a knife fight. Gross margins have been squeezed into the low single digits for many players. Smaller startups are burning through cash, while giants like BYD and Tesla trade profitability for market share. Analysts warn the next phase may bring consolidation, with weaker brands swallowed or exiting entirely. In this arena, the real race isn't just who builds the best EV, it's who can survive the financial strain the longest. And endurance isn't infinite. When margins thin, debt piles up, and demand wavers, even giants can run out of road. And that's the danger in a market running this hot. Thin margins, hidden leverage, supplier strain, inflated sales. When all four stack up, it only takes one shock, in demand, credit, or policy, to send the weakest players skidding. And the truth is, the impact wouldn't stop with China's newcomers. It could rattle the EV icon itself. In China, estimates put Tesla's 2024 new energy vehicles retail share around 6%, down from roughly 8% a year earlier. momentum has softened in 2025. Across Europe in the first half of 2025, Tesla registrations are down roughly 30%, even as EV uptake grows in parts of the market. And the US outlook? Chinese brands are exploring Mexico-based production to access North America, though policy risks remain high. Tesla still has muscle, Giga Shanghai with capacity near 1 million units a year. A supercharger network now at over 70,000 stalls globally. Autonomy pilots expanding in the US, but in China, rivals are pushing major product updates faster, eroding Tesla's first mover edge. And if the wrong policy hits at the wrong time, both Tesla and its Chinese challengers could be caught in the same crossfire. Because this contest isn't just decided in showrooms, it's shaped in courtrooms, ministries, and trade commissions. EU imposing additional duties of up to 38% on Chinese EV imports. These are maker-specific, with Tesla's rate on China-built imports remaining in the single digits. US. New rules will bar connected vehicle software from China and Russia starting in May 2027, with hardware restrictions by 2030. The IRA and FEOC rules also exclude EVs with Chinese battery content or critical minerals from federal credits. China's countermoves? Local brands are building or expanding overseas plants, from Thailand to Brazil, to bypass tariffs. If scandals like zero-mileage sales persist, the backlash could intensify, just as China needs export markets the most. Which brings us to the big picture, a boom that could be one shock away from crisis. We've seen this before. Industries that looked unstoppable until credit tightened, policy shifted, or trust broke. China's EV industry is in many ways a paradox. It is strong, built on scale that few nations can match, driven by deep vertical integration and powered by a pace of innovation that has stunned global competitors. But it is also fragile, burdened by razor-thin margins, reliant on opaque and complex financing structures, and dependent on policies that can shift with a single government decision. From here, there are only two clear paths. Scenario 1. Credit remains easy to access. Subsidies continue to flow. Export channels stay wide open. In this world, China doubles down and extends its dominance even further. Scenario 2. Credit begins to tighten. Subsidies are reduced or withdrawn. Tariffs start to bite. Suppliers demand faster payment. In this world, weaker players collapse, the market contracts, and the industry is reshaped almost overnight. And as the Evergrande saga showed, growth can hide fragility until the cash stops flowing. In EVs, the same overreach could turn today's boom into tomorrow's bust. The rise was fast, and the fall, if it comes, could be even faster. Which makes the closing question more important than ever. The rise of China's EV sector is one of the fastest industrial shifts in history, from niche startups to global dominance in under a decade. But speed cuts both ways. The same acceleration that powers growth can magnify a crash. In this race, winning the future will take more than selling the most cars. It will take trust, transparency, and staying power. Because when the dust settles, the winner won't be the first to cross the line. It will be the one still racing when the rest have broken down. And if you're an investor, analyst, or just watching the EV story unfold, the next 18 months may decide which names are still standing. So if you want to stay ahead of the curve, make sure you're here when we break the next twist in the race. Subscribe to StratyQ. The edge is in the insight,